Welcome to Gold Silver Pros.
Everybody, this is Rob Keens with 𝘎𝑠ilvrpros.com. This is your weekly market wrap-up for January 9th, 2024, the second Monday in January. Welcome, everybody, to the program. The big highlight of the stories for today is going to be how the World Bank says we're headed for the worst half-decade of growth in 30 years and what that means going forward. We'll talk about recession risk. We'll go over the gold and silver market. We've got some special deals for you in silver you can only find here at Gold Silver Pros. And we've got more information, including the polar vortex that's supposed to hit most of the United States here in the next few days. We'll talk about what that could mean for the economy and where you are and how that could affect your overall situation. So we're going to start off with what happened in the economy last week. It was the first really big week back from the holidays. And so we actually did get some pretty decent data. I'm going to lead off with manufacturing. Manufacturing was down. There was a 47.9 print on the S&P U.S. manufacturing PMI. Anything under 50 is considered lack of growth or deceleration or shrinking if you want. And that was also down from last month at 48.2. Construction spending is down. It was a healthy 1.2%. Last month, year over year, which is decent. It's not great. It's not a lot of growth. Well, now we're down to 0.4%. Job openings rose 8.8 million. And the really big deal are the jobs. And I'll get to the jobs here in a moment of last week. It's the first week of the month, the first Wednesday and Friday. We get the jobs reports. Job openings were up 8.8 million. The overall employment numbers for ADP were 164,000. Jobs created on expectation of 130 sounds good. Initial jobless claims were down from 220,000 to 202. So you look at more job openings, less unemployed, those types of things, new jobs created. It looked all good. And then certainly when we went to the government report, the BLS report, what they're calling the U.S. employment report, really the non-farm payrolls, was at 216,000 jobs created. The U.S. unemployment rate stayed steady at 3.7%. And wages were up 4%. It looked good on the employment front, but we're going to show you where the employment front was not so good here in a moment. We're going to really break that down for you. Before we do, though, big data on consumer credit. U.S. consumer credit tops $5 trillion for the first time in November. So the November data is in. Credit growth surges at a 5% annual rate. Previously, prior years is at 1.4%. So we're surging at almost 4 times what we typically see in consumer credit. And the over 19 billion taken last month of the 20-something billion in consumer credit on revolving credit, like credit cards and those types of things, was the second highest revolving credit balance increase in history. That's the second highest revolving credit balance increase in history. So apparently consumers tossed caution to the wind. They bought to finance the holidays. It was not only buy now, pay later plans, which we talked about, going over 1 billion of those, but also consumer credit surged. The second highest in history revolving credit increase of over 19 billion was in November. So the consumer is totally tapped out, and it doesn't look like that's getting better anytime soon. Talking about jobs, which we'll get to with the screen share, I want to show you what actually happened on the jobs report. Honestly, this is a data point that's probably the most confusing to go over. If you listen to the job numbers, you'll say, well, unemployment's only at 3.7%. That's the old U3 number. It doesn't count a lot of things. And if you dive deeper into the report, you'll get, this is a screenshot from a Zero Hedge story that I put out on X or on Twitter last week. And thanks to Zero Hedge for the graphic. They dug deeper and looked at the actual data. And you can see that full-time jobs went down by over 1.5 million in December. The increase of part-time jobs was 762,000, and there were 222,000 multiple job holders, meaning people basically lost their full-time jobs and their benefits. They went to part-time jobs, and more people were doing multiple of those to make up for the fact that they didn't have a full-time job. And that's the real situation with employment. So unemployment may be sitting at 3.7% per government numbers, but there are many less people that actually have full-time employment. People that are getting employment, it's almost all part-time jobs without benefits and those types of things, insurance, and people are working, the amount of people working multiple jobs just to make money has gone way up. And at the end of the day, that tells the real story, on the employment situation. All right, we're going to get to the deal of the week before we get into the rest of the data. Right after this, I'm going to give you the view on the economy. We're going to go over gold and silver, and I've got some really interesting data on the COT report and gold and silver for you here in a moment. But first, I want to talk about our sales of the week. So we'll go ahead and put those up on the screen. We've got 1 ounce silver maples. These are going to be random year. Most of them will be 2023, could be some years prior, for $2.99 over spot. That's 1 ounce silver maples, $2.99 each per ounce over spot. We have the 1 ounce Britannias, $2.75 over spot. 1 ounce silver Britannias, $2.75 over spot. What you do to get access to those is you have to go to the website and basically sign up. So we'll do a share screen there. You go to www.goldsilverpros.com. You click on the discounts tab up here up top. You click on access discounts here, and it opens up this form for you guys where you fill it out. You put your contact name, your number, your email and phone number at least, so we can get a hold of you and give an address later if we end up doing the deal. That's perfectly fine. So you simply fill out the form. We'll call you. We'll email you. $500 minimum on these, on silver, to get these prices. And if you're interested, for the first 4 people that order the maples at $2.99 or the Britannias at $2.75 and spent at least $500, we'll give away a free collectibles kit. This is a 1972 coin collector's set from the U.S. Mint. We have one of these. I've got a really cool United States Mint presidential coin proof set with certificate of authenticity here that we'll give away to one of the people that orders $500 in silver. I have, and that's a 2008, by the way, 2008 edition. I have a couple of older coin sets that have multiple quarters, half dollars and such in there that I'll give away. So I've got 4 of these different sets that I'll give away to anybody that orders at least $500 of our maples or our Britannias. Maples are $2.99 over spot per ounce, and Britannias are $2.75. We'll lock you in. Once you get that funded, we'll get that sent out to you. We'll drop ship it wherever you are in the country, and happy to do that for you guys. All right, back to the report. So we were looking at the economic data, and one of the things that we focused on was we focused on the unemployment, how those numbers aren't exactly correct. We focused on consumer credit. The picture that we're seeing here in the economy is that people don't have the jobs they used to, don't have the income they used to, and now they're living on credit. That's essentially what's going on. The stock market now is down as of reading this at about 1:15 p.m. Central Time. Today, Dow Jones is down about 156 points. S&P's down a couple of points. The NASDAQ's actually up 36 points on some tech rebounding in terms of earnings. The Russell 2000 small cap index is down. Bitcoin is down. The cryptocurrencies are down today. Bitcoin's trading down about $300. It actually had a nice end of last week. As I'm looking at the chart, last week it rose to the end of the week. This week it's falling off a little bit, just like gold. We'll get into gold there in a minute. And the bond market, it's what's really going interesting there is the risk is going up. We had this really sort of euphoric 60 days in the bond market where the rates were going down. We had the 2 come under 4%. We had the 10-year almost come under, it was under 4%. Now the 10-year is back over 4. It's up 0.011 points today at 4.013. So it literally just came off the ground of 4%. The 2 years at 4.377. Now you still have the yield curve inversion. The shorter term 2-year is demanding a higher interest rate than the 10-year, which means people see a recession on the horizon. That's the biggest recession indicator, is the yield curve inversion. But overall, the bond rates are coming back up. So after the holiday season, people immediately in January are seeing more risk with the bonds. They're seeing more risk with the overall economy. So the rates are starting to come back up. Biggest story and one that's going to headline this report is a report from Davos 2024. The global economy is set for its worst half decade of growth in 30 years, the World Bank says. Let me share that report with you and go down it. This is on CNBC. It says the global economy is on course to record its worst half decade of growth in 30 years, according to the World Bank. Global growth is forecast to slow for the 3rd year in a row in 2024, dipping to 2.4% from 2.6% in 2023, the bank said in its latest Global Economic Prospects report. Now, one comment I'll make is, if you look at the official CPI numbers or inflation numbers for most countries, it'll still show positive growth because a lot of inflation is built into the GDP numbers. But if you look at real, not nominal inflation, but real inflation in terms of what you actually pay for goods and services, and you get beyond the gobbledygook of the government numbers, you'll realize we're actually not growing. The world has not seen 2.6% growth in 2023 or 2.4% in 2024. What they've actually seen is negative growth, but because all the governments fudge on their inflation numbers, it looks like we're still in a growth. We're actually not in a growth. We're actually not growing, we're shrinking. It says here, without a major course correction, quote, the 2020s will go down as a decade of wasted opportunity. Enter McGill, the World Bank Group's chief economist and its senior vice president, said at Davos. A quote from the CNBC article, the global economy is on course to record its worst half decade of growth in 30 years, according to the World Bank. Global growth is forecast to slow for the third year in a row in 2024, dipping to 2.4% from 2.6% in 2023. Growth is then expected to rise marginally to 2.7% in 2025, though acceleration over the 5-year period will remain almost 0.75 of a percentage point below the average rate of the 2010s. And despite the global economy proving resilient in the face of a recessionary risk in 2023, increased geopolitical tensions will present fresh near-term challenges, the organization said, leaving most economies set to grow more slowly in 2024 and 2025 they did the previous decade. So in other words, they're not expecting growth pretty much at all in the next 5 years. And the first 5 years as one of the worst starts to a decade in basically 3 decades. So we're not doing well. And if we had real inflation numbers, you would see that we're doing even worse than they report. And that's why I think 2024 is going to be a year of turbulence. And I think 2024 is going to be a year in which we see gold and silver do very well. Let's go on to the gold report. Going over to the CME group, you can see there's a little bit of a rise in interest. And whenever I see this rise in interest, I immediately think shorting. Why? Because that's a pattern. And I'll show you the COT report, which is a lot of this is shorting. We'll show you that data. So if you look over here at the gold report as of today, the dominant month right now is in February. That's quickly changing over into April. You've got 101,000 contracts today trading for April, but right now 332,000 for February. So that's the month in which we will pay the most attention to in terms of where the spot market is, because this is where spot prices are largely determined in the US. We see that there are 2,965 EFPs. That's exchange for physical. That's trading a futures contract for February into an OTC contract in the UK in that market, either hunting for price differences or looking for physical. These EFP numbers have been elevated the last couple of years. Actually, the last 4 or 5 years, we've seen more EFPs than we traditionally have seen. The last 2 years, the exchange for physicals on gold have been very, very high. People are hunting for gold, and they're not necessarily getting on the US exchange. A lot of times, they'll go over to the sister exchange in London. 2,392 EFPs for Friday's data. Looking back at Thursday's data, 3,300. So every week now, we're seeing 10 to 15 to 20,000 contracts rotate over from the US to London, looking at that physical, either the difference in physical price or actually hunting for the physical itself, according to the way that exchange mechanism works, according to CME Group. Looking at the settlement and volume data, I just clicked over here on settlements, and that would give you the price action. So on February, so far today, through 1 p.m. today's data in February, we've had gold's down about 50 cents, not a whole lot, to about 20.33. And if we look at yesterday's data, gold traded down about $16.30 on the February contract. If we go to Friday's data, it was up about a dime. And we go to Thursday's data, it was up $7. So a lot of the shorting has occurred over the last couple of days, but we also had shorting at the beginning of the week. You can see Wednesday last week down $30. So the pattern has changed a wee bit. The pattern is usually it goes up heading into the week on Monday, Tuesday, Wednesday in the US and comes down at the end of the week. That pattern's actually reversed the last couple of weeks. It's been down the beginning of the week and then going up towards the end of the week just a little bit. So a little bit of change in the pattern, but not too much overall. We're going to go to this chart. And if you've seen this chart on my program, this is where we look at the actual physical gold. This chart is looking at the derivative trade. It doesn't really have anything to do or a lot to do with the physical trade because only a very small percentage of this is ever delivered. If you want to prove that, you go to look at one of the datas and you look at there's 10 deliveries because there's not a lot of contracts in January. It's only 51 contracts right here, only 10 deliveries. That's part of the why you see EFPs if people are hunting for delivery in the current month. They go to London and say, hey, can I get some delivery? But they'll also go and they'll invest in these ETFs. And the ETFs, along with COMEX, so you see the 3 numbers here at the top of COMEX, are basically the amount of big gold depositories in the Western world for all intents and purposes. This is why I like to show this chart. Overall, after the last 4 weeks, gold has come off out of the Western world depositories by 1.2 million ounces. And overall, gold's been falling for the last 3 years. 3 years of being pulled off the indexes. There's been a little bit of gold coming back in the last couple of months, but net, it's been pulled off for about 3 years. This is a 3-year trend where gold's being pulled off of all of the coffers around the world. Now we're going to go look at the CFTC COT report. It's Commitment of Traders report. We're going to look at gold. We'll look at silver here in a moment. This is gold, and this is through January 2nd. So if you want to know why the gold and silver price are going up and down, you look at what the traders are doing on the paper market, because the paper trade is what determines spot price, not physical, not this. This is physical. This is not used in the calculation of spot prices. This is used in the calculation of spot prices. All of this paper trading, this 332,000 traded contracts, 99.99999% of that is paper with no physical movement, and that's what determines spot price. And so we look at this Commitment of Traders report here that I've got highlighted for you to determine who's moving the price around. And you can see, if you want to know if it's going down, you look at the shorts. Here's the highest short position increase through January 2nd. 8,162 contracts increase from the week leading through January 2nd from the swap dealers. Who are the swap dealers? The bullion banks. They also happen to be the 4 or less 8 traders that are short gold the most, 32.9% and 50.3%. And how do you know? Because they have the biggest short position. Look at the numbers I'm highlighting. This position here, the swap dealers of the bullion bank, translates to this number down here. They have all the short positions. So if you're wondering who is making the price go down, it's usually the people with the biggest concentrated short position and who's adding or subtracting to it on a weekly basis. And you can clearly see the banks have the biggest short position, and they added the most shorts this week. The producer merchants actually dropped shorts and went net long. The managed money actually dropped shorts in gold and went net long. And the other reportables, the wealthy individuals added some of their own. So the wealthy individuals and the banks decided to go short gold. That's why the price went down, because they threw a bunch of paper on there. It has nothing to do with physical, because you can see physical is leaving coffers because there's a 3-year trend. People are buying gold and keeping it. But when you have paper trade on top of it like this, where people can short the hell out of it, even though there is ridiculous physical demand for 3 straight frigging years in a row, the price doesn't go anywhere because of the paper piled on top. That's what causes it. It has nothing to do with physical. So if you're wondering if gold and silver is popular right now, look at this chart and look at the last 3 years. Does that look like it's popular when people are pulling it off the exchange? Not only are they moving it around on the depository, they're actually yanking it out of the exchange. It's coming out of the exchange. It's coming out of the ETFs. These are the big repositories around the world, as represented by this chart, which is why I always show it. So regardless of what's going on with the paper shorting, which has nothing to do with the physical, which is leaving coffers and going, most of it going east into Asia and other Middle East and other places, it's the paper games that keep the prices down. That's why I show it. All right, moving on to silver. We look at volume and OI, a little bit of a spike here. This is through January 3rd. This reports through January 2nd. So this spike up here is what we're going to see in the COT report, not these 3 days on the end, but this spike up here. And we'll get to the COT report in a minute. But was this is a higher candle than the rest. Do you think this increase in trading was shorting, or do you think it was going long? Wow, gee, I don't know. Let's go look at the COT report in a minute, but I'll give you one guess. If we look at the trade, March, not February, is the dominant contract month for silver right now. And gold is February. For silver, it's March. And there are 104,000 contracts. Some of them are rolling off. You see people are rolling off of March and starting to move into May, starting to move in July. But March right now is where the price is really determined. That's got the most trade. You saw EFP's 280. The EFP's moving to London to get physical silver has not been as popular as it has been to get physical gold. So there's some EFPs here. They're not a ton. And there's one delivery. You know, it's not a big delivery month in January. So you're not seeing physical deliveries here. You're seeing some people go hunt them in London, but yet they're still coming off the depositories. You see here, how does that occur? I'll get to that here in a moment. But looking at the paper trade, that's what we have. So that's Monday's data, 104,000 contracts. Friday, We had 105,000 contracts. We have a healthy silver trade, by the way. There were 650 EFPs Friday. So overall, a healthy trade in silver. I mean, it's not as busy as it was in December. It's not as busy as it is in some really big months, but there's some trade there. Looking at the actual settlement data, this is Tuesday's data through 1 p.m., through about 20 minutes ago, which is why I record when I do. So you get that, that 1 p.m. number. You'll get interim data. This is interim data for today. 37,880 contracts traded. Silver's trading down about 22 cents today. What did it do Monday? It traded down about 5 cents. Now, remember when I told you the trade's the opposite of what it normally is? Normally at the beginning of the week, gold and silver go up and they fall at the end of the week. So that the weekly close is lower and it doesn't attract a lot of attention. Well, the last couple of weeks, it's been falling at the beginning of the week and then rising at the end. So who's bidding on that gold and silver and why? I wonder if foreign traders are coming in at the end of the week instead of the beginning, and they're learning the patterns of the market and they're bidding up the price at the end of the week. Maybe it's more favorable for them to do it because it's traditionally a weaker part of the week for the metals. But in any case, that's what's going on. If you look at volume and OI, price, settlement, that tells you about the price. We went over that for a couple of days, 22 cents down. Tuesday, Monday was down just to 5 cents. Going back to last week, it was actually up, like I said, 12.8 cents, 13 cents. So for the last couple of weeks, gold and silver have traded differently. They've gone down at the beginning of the week and gone up at the end. And that signifies to me something has changed with the trading, but it's not a big enough trend for me to have enough data to tell you. But something has changed in the derivative markets, gold and silver. Now, they're still shorting the hell out of it. We'll get to the report for silver for a minute. But you can see in the last 3 years, a ton of silver's come off of worldwide depositories. Millions of ounces. It was at 1.7 billion ounces, and now it's sitting at 1.3 billion. So 400 million ounces in the last 3 years has come off. That's about a quarter of all the well-known silver depositories coming in the Western world in the last 3 years. A quarter of it's come off. So if you ask me, is there a silver shortage? Yeah, because the mines aren't putting on enough output, and so they're draining it. I think gold they're draining for monetary purposes. Silver, it's for industrial purposes. There's some investment in there, but they're draining silver for industrial purposes. The mines aren't producing enough. And that's the reason why. And you can see COMEX actually added quite a bit of silver. A lot of silver's flowed into COMEX the last 4 months, 13 million ounces. That's a healthy amount. Now you're looking at 281 million ounces total. So 13 is a small portion, but it's about 5%, something like that. Not too bad. But overall, there's been 21 million ounces flow back into silver. You see a little blip here. Now it's nothing compared to the 4 million ounces that come off. But the higher silver price we had for just a wee bit has enticed some free silver back into the market. Not enough to make up for the last 3 years of runoff. Certainly not enough to make up for the lack of global mine output. But certainly there's been a little bit of fraudiness in silver fiscal, which is good to see. Now, if we move down the COT report to silver, here's silver. And again, this is through January 2nd. The people that have the biggest shorts right now are a combination of producer merchants and swap dealers. Now, producer merchants are going to do it because they're protecting their production of silver from price changes. This is called legitimate hedging. So don't worry about this too much. They've got to short because that's how their business runs. The banks short, either they're shorting for their clients that need shorts or they're shorting for their own book, but they're not producing silver. Now, can they represent silver companies? Sure. But the silver companies have their own trade. So most of the shorting for legitimate mining purposes is done in this column right here, producer merchants. It's not done over here. Some of it is, but most of the shorting is just speculative. I'm telling you right now. And they actually reduced their speculative position by 2,000 contracts, but that's after running it up because the swap dealers at one point about a month ago were sitting even about 34,000 contracts each, long and short. And now they're about a $13,000 net short position in silver. I'm sorry, 13,000 contract. And that's 5,000 ounces of silver. So 13,000 contracts times 5,000 ounces. That's millions and millions of ounces of silver they're sitting short in paper terms. And that's why the price came down through January 2nd, because they have such high shorts. Now, they did reduce some of the shorts, and the managed money took the other side. So, this did allow silver to rise just a bit. But for the most part, in the last month, they've been shorting the darn heck out of silver. And that's why the price has been repressed. Now, moving over to the Shanghai market, we've got the Shanghai report here. The one thing I wanted to show you in the Shanghai report, let me make this bigger. The thing that I like to focus on is most of this is physical delivery. So while you look at the US market and it's not even 1,000% delivered every month compared to the actual contract trade. So people put in a bunch of contracts, determine spot price, but only this much of it is actually physically traded. It's different in China. On the Shanghai, it's a very physical market. You can see here in gold, almost 80% of the gold was physically settled, not 0.001%, 80%. And in silver, 15.35. And if you look at the accumulative total for the year, that's a little bit higher than the year average for gold, a little bit less for silver. But still, there's a lot of gold and silver physically settled on the Shanghai market, and prices tend to be higher. That's why prices rise at the beginning of the week. That's why there's a difference in price between the Shanghai contract and the COMEX, which I show you guys all the time. So they're delivering a lot. So a lot of this gold and silver that's flowing off, this exchange here, all these Western exchanges, that's for gold. And here's silver depositories. And that flows off here. It's going over here to Shanghai, where it's being physically taken off the market. That's how that works. It's flowing west to east and being taken off that market because that's a delivery market. So you're seeing, product move west to east. Going over to London, covering that, we actually had an uptick in the amount of gold available in London and a little bit of an uptick of the amount of silver available in London. So London is not in a shortage position with gold and silver, at least in terms of monthly flows. Now, they may not have enough to really provide all the gold and silver physically delivered that everybody wants, but London seems to be doing pretty healthy. So I suspect a lot of the gold and silver coming off the U.S. is moving through London and eventually making its way to the east. And that's basically what we got. That is your market wrap up for the week. Just to sum, the World Bank says this is the worst half decade in 30 years for global growth. If you take real and not nominal inflation numbers or non-governmental inflation numbers, the world has not been growing the last 5 years. It's been shrinking because inflation is much higher than the governments around the world are reporting. So we haven't had growth. The consumer is over leveraged and had the second worst revolving credit increase in history in November leading up to the holidays. I said that would happen. I showed you the buy now, pay later plans, and now we have the revolving credit, and people lived it up this Christmas, traditional style, but it was all on credit. So the consumer is dead right now. And I expect we're headed into a major recession this year because the consumer is completely and utterly dead. And if you look, corporate profits are up, but that's because of job loss numbers. Corporate profits are up 50% in the last 10 years. But that's because they've cut full-time positions. We saw that in the job data. 1.5 million comes off, 772,000 increase in part-time jobs, and 222,000 increase in the amount of people working multiple part-time jobs. And that's why people are living on credit. So people have less money. They're spending less. What they're spending is on credit, and that's jacking up the credit numbers everywhere. That's why indebtedness is going up. And with higher interest rates now, that's going to cause a stagnation of the economy. That's why we're in stagflation. That's why the economy is going nowhere. And if the Fed doesn't cut this year, we're going to have major problems. But I also think if the Fed cuts and they go to more of a QE framework, then you're going to have the easy money. And that'll be the last straw before the economy breaks because there's already too much debt in the system. You add more debt load onto that through QE and through loosening of conditions, that system's over. You're going to break that system. Also, lastly, to sum, I have silver on sale. Maple's $2.99 per ounce over spot upon funding. Britannia's $2.75 per ounce over spot upon funding. And for the first 4 people that order at least $500 of that, and they confirm and pay for that order, we'll give you one of these coin sets. I had a couple different coin sets for you guys. These are just proof sets. These are not gold and silver coins. For the most part, these are regular everyday coins, but the proof sets are really cool. And that's a free gift for the first 4 people that order $500 in silver at the prices that you see on your screen. 1 ounce silver Maples, $2.99 over spot. 1 ounce silver Britannia's $2.75 over spot. This is limited time. This is limited availability until we run out. Go to www.goldsilverpros.com, click on the discount link, click on access the deals, fill out your information, and we'll get back to you on getting that deal done. Thank you so much for paying attention to the channel. This is the weekly market wrap up for the second week of January, for January 2024. On Thursday, we're going to have great content for you. Stay tuned to the channel. We've got a lot more coming. Until next time, Rob Keens with goldsilverpros.com.